and welcome back to Intelligent Investment Today. This is a podcast where we explore the timeless lessons of value investing. The idea is to help investors navigate markets in both good times and bad, through periods of uncertainty, volatility and change. And today we turn our attention to a behaviour that appears in markets time and time again: the rush to cash. It seems that whenever uncertainty rises, whether that happens to be driven by financial crises, economic recessions, or geopolitical conflict, investors often respond in the same way. They sell risk assets, they reduce exposure, and they move into cash. It feels safe, it feels prudent, and it feels like the rational thing to do. And in the context of recent geopolitical tensions, including the current situation involving Iran, we are seeing this behaviour once again. Markets become volatile, headlines intensify, uncertainty increases, and many investors instinctively seek the apparent safety of cash. But today I want to examine that instinct a little more closely, because while holding cash can provide short-term stability and peace of mind, it also comes with risks that are far less visible, particularly in environments where inflation is elevated. What may appear safe on the surface can, over time, quietly erode wealth. And understanding that distinction is an important part of intelligent investing. So, as always, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. In times of crisis, investor behaviour tends to follow familiar patterns. Uncertainty increases, markets become volatile, and the natural human response is to reduce exposure to risk. And this is far from being irrational. When faced with unpredictable outcomes, preserving capital becomes a priority. And cash, in this context, offers something very appealing: certainty. Unlike stocks, which can fluctuate dramatically in value, cash appears stable. Its nominal value does not change from day to day. $1 today is still $1 tomorrow. And in moments of market stress, that stability can feel very reassuring. There is also a psychological component at play. During periods of falling markets, losses feel immediate and uncomfortable. Holding cash, by contrast, feels like stepping out of that volatility, taking control, and avoiding further declines. And this sense of control can be powerful. It allows investors to feel as though they are protecting themselves from uncertainty rather than being exposed to it. But while this instinct is understandable, it is important to examine whether cash is truly as safe as it appears. But before we consider the drawbacks, it's important to acknowledge that cash does have genuine advantages. First of all, liquidity. Cash provides immediate access to capital. It can be deployed quickly when opportunities arise, particularly during market downturns, when assets may become more attractively priced. Second, stability. Cash does not experience the day-to-day volatility that is associated with equities. For investors with short-term liabilities or low tolerance to market fluctuations, this can be valuable. Third up, flexibility. Holding cash allows investors to wait. It creates options. The ability to act when conditions change, rather than being fully exposed at all times. And these are meaningful benefits. And in certain circumstances, holding cash can be entirely appropriate. But the problem arises when cash is viewed not as a tool within a portfolio, but instead as a long-term safe haven. Because that perception can be misleading. For the stability of cash is, in many ways, an illusion. That's not because its nominal value changes. It doesn't. But because its real value does. Cash may remain constant in numerical terms, but what it can actually buy changes over time. And this is where inflation becomes critically important. Inflation, of course, represents the gradual increase in the prices of goods and services across the economy. As prices rise, the purchasing power of money declines. If inflation is running at 5% per year, then the real value of cash is effectively falling by that same amount annually. But unlike market losses, this decline is not immediately visible. There is no daily price movements to observe, no sharp declines to react to. Instead, the erosion happens slowly, quietly, and often unnoticed. To understand the impact of inflation, consider a simple example. An investor holds $100,000 in cash. If inflation averages 5% per year, the real purchasing power of that money declines steadily over time. After a decade, the same $100,000 may only buy what $60,000 could purchase today. Yet the nominal value has not changed. And this is why inflation is often described as a silent risk. It does not create the immediate discomfort of market volatility, but over time it can have a significant impact on wealth. And during periods of economic instability, which often accompany geopolitical tension, inflation can become particularly elevated. In such environments, holding large amounts of cash may very well feel safe in the short term, but can be damaging over longer periods. And this brings us to an important contrast. Stock holdings represent ownership in businesses, and businesses operate within the real economy. When inflation rises, companies often have the ability, although not always, to adjust their prices. If the cost of inputs increase, businesses may pass those costs on to customers, and this leads to higher revenues in nominal terms. And if managed effectively, profits may also increase. Over time, this ability to adapt allows many businesses to maintain or even grow their real value. For investors, this means equities can act as a form of protection against inflation. While share prices may fluctuate in the short term, the underlying earnings power of businesses can rise alongside prices in the broader economy. But of course, not all companies are equally equipped to handle inflation. The key factor here is pricing power. Pricing power refers to a company's ability to raise prices without significantly reducing demand for its products or services. Businesses with strong brands, essential offerings, or limited competition are often able to do this more effectively. These companies can protect their margins even when costs rise. And for investors, owning such businesses can provide a degree of protection against inflation. Cash, by contrast, has no such mechanism. It does not grow. It does not adapt. Its value remains fixed, while the economy around it changes. Another important consideration is the opportunity cost of holding cash. During periods of market stress, investors who move heavily into cash may indeed avoid short-term losses, but they may also risk missing the recovery. Markets are forward-looking. They often begin to recover before the underlying uncertainty has fully resolved. Investors who wait patiently for clarity may find that asset prices have already risen and that they have missed the boat. Over time, missing these periods of recovery can have a significant impact on long-term returns. And when combined with the effects of inflation, the cost of holding excessive cash becomes even greater. None of this, of course, suggests that cash should be avoided entirely. Cash does play an important role in a well-constructed portfolio. It provides liquidity, stability, and flexibility. But like any asset, it must be held in appropriate proportion. The key here is perspective. Cash is not inherently safe nor unsafe. Its role depends entirely on how it's used, how long it's held, and the broader economic environment. In times of crisis, the instinct to seek safety is perfectly natural. But intelligent investing requires us to look beyond instinct and consider the full picture. So let's summarise. Periods of uncertainty often lead investors to seek refuge in cash. And while that instinct can provide short-term comfort, it is also important to recognise the trade-offs involved. Cash offers stability in nominal terms, but in real terms, its value may be quietly eroding. Equities, while more volatile, represent ownership in productive assets that can adapt, grow, and potentially preserve purchasing power over time. Understanding this distinction is essential, because the goal of investing is not simply to avoid volatility. It is to protect and grow real wealth over the long term. And on that note, we draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed this exploration of cash, crisis behaviour, and the often overlooked risks associated with holding money during inflationary periods. If you have found the episode worthwhile, do consider subscribing or adding it to your playlist. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.